We had that rand and the markets as well, opening firmer this morning, quickly turning around and everything back in the red. So a really negative week for the JSE.
Yes, absolutely, Stephen. It certainly was a very short-lived rally that we had this morning, and since then it's been a very slippery slide into negative territory, and probably expected to remain in negative territory. The market remains very nervous, really no clear sense of direction of where to next, and the market quite nervous about upcoming events.
Nerina, take us through some of the factors that are creating this uncertainty and this nervousness in the market.
I think it certainly started with the weekend's events with the assassination of Osama bin Laden, and I think the initial reaction on Monday, which was a public holiday in most markets, there was a lot of initial very positive reaction, but that also disappeared quite quickly. I think when the reality set in that really not only does it not change anything in terms of on the ground economics and the reality for the financial markets, but if anything it's quite possible that this actually increases the risk profile in the world. So I think by the time most market pundits returned to trading on Tuesday, the outlook looked quite different than it did on Friday, in the sense that there was an increased risk aversion. So I think the effect that you had in terms of the markets, that you had a weakening again of the US dollar at that stage, that certainly led to a spike in the gold price. I think on Monday there was an intraday high of 15.75 to the US dollar for the gold price. It's since retreated from those levels because I think the reaction in terms of the risk averseness was a flight to safety in terms of US treasuries, certainly for the US investors, and this has certainly resulted in some relatively short-term strength for the US dollar, although as we move through the week that has turned around again, and we are currently US dollar relative to the euro again reaching towards that infamous 150 level against the euro.
Well, despite the dollar heading to 150 against the euro, that's not being reflected in commodity prices because they remain weak at the same time. In fact, gold trading at $1,509 an ounce. We've got platinum under pressure, silver's taking a big knock, copper as well, and that's really hurting our markets in particular, Nerina.
Yes, that's very true. I think, and certainly in terms of the gold price, the safe haven status of gold, I think, has to some extent also just been shifted a little bit into the US treasuries, as I mentioned there. But certainly the dollar translating into the commodity prices there. On the oil side, also there's some other aspects also there. We had a sudden and unexpected sharp increase in US crude oil inventories that was not really expected. So that led to some weakness in the oil price, and there's also concern about the ongoing monetary tightening in China and what impact that would have from the demand side on the energy spectrum. So I think that's another reason why the oil price is also just a tad softer. Bear in mind, of course, it is still at exceptionally high levels, so we are in all cases really talking about commodity prices that are weaker but from very, very high levels. So when we look at the global inflationary pressures, when we look at particularly the likes of the energy spectrum and other input costs into many of your manufacturing processes, we are still dealing with exceptionally high commodity prices, which is putting a very, very strong pressure on input costs for many manufacturing processes, and therefore leading to a lot of inflationary pressure worldwide.
Well, apart from China, we also have the ECB and the Bank of England meeting this afternoon to decide on interest rates. And the feeling is that the ECB will keep rates unchanged at 1.25%, but is going to remain hawkish. How do you see this playing out in the markets, and particularly with the dollar-euro play?
I think the ECB is really indicative of the dilemma that many of the developed world and in fact other central bankers also find themselves at the moment. I just spoke about the inflation problems just recently, but at the same time many of these also have to deal with the rising inflation on the one hand, but then a lack of growth on the other hand. And for many central bankers, the very blunt instrument called interest rates is often one of the few instruments instruments that they have to try and fight the inflation, curb the inflation, but in the same time also try and stimulate growth. Now, we know that interest rates have been at exceptionally low levels in developed markets for an extended period now, and unfortunately it doesn't appear as though that has translated into sustainable growth, something which is desperately needed by the world at this stage. The expectation is that the ECB will keep their rates on hold. They did start rising them in recent times, but the expectation is that for now it will be on hold, mostly because the growth scenario is more fragile than the inflation fears are at this stage. Also because increasing interest rates is not really going to make much of a difference to your inflation scenario. So these inflation impacts and shocks are all exogenous and are not influenced by the level of interest rates. This is exactly the same scenario that we have in South Africa also, where increasing interest rates is really not going to make much difference to the cost push inflation that we are experiencing, and interest rates are rather kept low in order to try and stimulate growth, although it's not always successful.
Well, in the meantime, we have had a few numbers out of our market this morning. We had Harmony Gold coming out with its March quarter earnings. Profits up 32%, 91 cents a share. Seems to have been a bit shy of expectations, although that share price did rise in early trade. I'm not quite sure what it's doing at this moment, because we have seen that gold price pulling back again.
Yes, it was a little bit short of expectation, and I think some of the other gold counters have actually fared a little bit better. The gold counters have been under a little bit of pressure these last couple of days, with gold itself coming back from those heady highs. So yeah, I think that maybe the expectation in Harmony was a little bit rich on the back of that very, very strong gold price in dollar terms. For most of the gold companies, the input costs in rand terms do remain a big problem, both the labour aspect of it as well as the energy cost, the electricity cost for them. So slightly shy there, but Harmony not reacting too poorly on that set of results.
Well, Mondi also coming up with some quarterly trading updates. March quarter profits looking pretty good. It also does, of course, warn about rising input costs.
Yes, Mondi actually operating in a very robust environment, especially in Europe at the moment. They're currently experiencing a very strong price rise environment, both in terms of the prices that they can actually charge, but unfortunately also on the input cost side. So the strong momentum that they had in the first quarter seems to have followed through into the second quarter so far, and their trading update seems that they will be publishing a good set of numbers for the first half. So certainly a strong trading update. They also bounced very, very sharply on that news, and by far the best performer within the top 40 for the day. However, we do believe that further into the year, as we reach into the second half, that the input cost pressure is going to start eroding the benefits that they have on their top line growth, and that we feel that this might present an opportunity for investors to rather sell into the strength, because we do not believe that the margin expansion that they've experienced is sustainable.
Nerina, one share that came under big pressure yesterday, that was Naspers, of course, again a company with exposure to China. That share recouping some of those losses this morning. Your view on Naspers, just given the dynamics playing out at the moment?
Well, I think Naspers was particularly affected by more what is happening in the space with Tencent, the large holding that it has in China. And in Tencent's case, it's really about the new competitor that it has on the horizon, a company called Ren that listed in New York yesterday. The ADR's listed there, listed at $14 a share, closed at $18 a share. So certainly a very, very strong rise there. And the fear is that because Ren has got a great war chest, certainly on the acquisition path and on the growth path, that they would represent a big competitor for Tencent. So that would obviously be negative for Naspers, and our view is that is the main reason why, just in the very short history, Naspers has been underperforming. But of course also the growth outlook for China and the fears about further monetary tightening in China does also have an impact in terms of Naspers' outlook there. And of course Naspers being in the media space and the technological media space in particular, every time when there is talk in terms of clampdowns, lack of ability to involve Google, social networking and so on in China, this is negative in terms of the sentiment around Naspers. But generally speaking, this is still a very strong growth market. So it is still a great environment for Naspers to be involved in. I think the concerns for the investors might just be that it's a fairly concentrated exposure that they have in terms of China. If I contrast that to the likes of SAB Miller, that also has a big exposure in SAB, in China, and they balance that with a lot of other exposures in other emerging markets that allows them to enjoy the benefits of the strong growth in emerging markets, but a much more diversified basis.